Hello, chart watchers and Decision Point faithful. Welcome to this Monday, June 27th, 2022 episode of Decision Point. My name is Erin Swenlin from DecisionPoint.com. My father is not able to join us today, but I'm sure we'll see him in 2 weeks when we do return. Next Monday is a holiday, so there will be no live Decision Point show, but we will be back the following Monday. So I'm going to start off today. We'll look at our market and indicator overview. I'm going to show you the major indexes on our scoreboards. Then I'm going to take a deep dive into energy and healthcare. These have been really two opposite sectors of late. Energy really falling down and stumbling, whereas healthcare has really been starting to make the move to the upside. So I wanted to cover those sectors in depth. And then after that, I have some industry groups of interest, industry groups that have really come out in the forefront for me when I've been doing my research for my Decision Point Diamonds subscribers. So I will finish with 2 diamonds of the week. Actually, I have 3 for you today. They were actually last week's diamonds in the rough, but I think they still look pretty good moving forward. So I will be sharing those with you as well. So first of all, I want to let you see our scoreboards here on the left, the market index scoreboard and the sector scoreboard on the right. As you can see, plenty of red marks on these. These are intermediate term trend model and long-term trend model signals on both of these. A long-term trend model signal is a golden cross, which will get you that buy, or a death cross of the 50 and 200-day EMAs, and that will get you these sell signals in the long term. In the shorter term, an intermediate term trend model buy signal is generated by a silver cross or a 20, 50-day EMA positive crossover. The opposite, of course, is a dark cross, which all of these sectors and all of the indexes currently have. Neutral being that the negative crossover of the 20 and 50-day EMAs occurred beneath the 200-day EMA. That becomes a sell. If that crossover occurs above the 200-day EMA, we move into a neutral signal, which is basically fully hedged or completely in cash when you're looking at it against what we're seeing. We don't want to go into a short or a sell signal if we still have a 50-day above the 200-day. So that's kind of our thought process as far as neutrals versus sells. Before I get started, I don't like to be salesy, but I'm going to tell you really quickly, if you buy our bundle right now, you'll get the first month for $14, use coupon code BEARS. But bear market going on, figured you could use a little help. And so that's what we are offering right now. Okay, so let's move forward and look at what's going on in the market. So today, actually, we did see the S&P up for part of the day, but it did end up finishing lower. But notice it's still sitting on that 20-day EMA. The rising trend has not been at all compromised, and our indicators are still showing some positive activity. The PMO is in the process of triggering a buy signal. In fact, if you go by the hundredths of a point, you will know that actually you have to go to 1,000th of a point, and it actually is a positive crossover currently, but it shows as even Steven here on the chart itself. But we did get that crossover on the SPY as well as on the OEX, but I'll show you that shortly. All right, so 20-day EMA is holding up. We do have a possible falling wedge here. I think we can see it a little better on the 1-year chart. Well, I don't have it annotated, but basically we are looking at kind of a falling wedge, which is a bullish pattern. So the expectation actually is a breakout from the current declining trend. Carl and I aren't that optimistic about that. We've got the 50-day EMA here hanging over our heads. We have the $405 level holding over our heads here for the SPY. You can see very strong overhead resistance. We still are looking for this bear market rally to carry us to that 50-day EMA. Then we'll have to reevaluate and see where our indicators are sitting. But right now, you can see we had a little bit of a positive OBV divergence coming into this bear market rally. You can see that stochastics are finally rising here and almost in positive territory. And the VIX, we do invert it. And on this inverted scale, we do see the VIX above its moving average. And that tells us that we might have some internal strength building because investors are not as bearish as they were down here. All right, next up, let's look at some of these indicators. Our climax indicators, we did get an upside exhaustion climax on Friday, and that told us to expect either some churn, maybe some lower prices over the next day or two. More often than not, and what we were looking at on Friday, Carl and I, when we wrote up our DP weekly wrap, was the fact that, you know, we have a lot going on this week. We have economic reports, we have earnings season beginning. And so there's probably a lot of tentativeness out there, and some churn wouldn't be too surprising after an exhaustion of that initial thrust to the upside. So we're still looking for some churn, but ultimately we are looking for price to at least come and test that 50-day EMA. If we get some churn and sideways action, we don't want it to be as lengthy as it was back here. That was our clue that things weren't going to work out to the upside as we had hoped. And when our intermediate term indicators turned down on this decline, we sent out the warning signal to our subscribers. Right now, the intermediate term indicators are looking much better, but we'll get there shortly. You can see STOs are still rising. We had a nice upward thrust. So we did call that, like I said, an exhaustion because these indicators were already starting to get overbought. Now we can see that they are still rising, which does suggest that we're going to see prices continue to rise. So participation has really beefed up here. We have 87% of the S&P currently have rising momentum. That's what can carry you. That's what can get a rally going and can sustain it. We're not looking at this as the end of the bear market by any stretch of the imagination. The economic conditions, the global conditions, nothing has changed. So in our opinion, the things that were, really are fueling this bear market and these prices moving lower, that hasn't gone away, but things have gotten very oversold. And so, of course, even on the way down, you're going to see some rallies, and our job is to help you take advantage of them. And I think that we will see some more upside movement up to this level here. Like I said, at about 405 is kind of where we're looking. Intermediate term indicators, as I said, looking better. I'm going to add the thumbnail here so we can see it a little more closely. And as you can see, the intermediate term indicators have turned up on this particular bear market rally. We have crossover buy signals now on about 1/3 of the members. So again, we're starting to see that improvement under the surface, which is what we need in order to sustain any kind of upside momentum. But seeing these indicators still rising tells me that we still have some upside potential left, at least in the shorter term. All right, let's get on to Bitcoin. Look at our major asset classes here. Bitcoin has just been clinging to life. Over last weekend, not this last one, the weekend before, we did see Bitcoin drop below that $20,000 level that we think is extraordinarily important. It did manage to get back above that level and is currently trading above that level, but really not going anywhere. The indicators have been suggesting we're going to get some higher prices here on Bitcoin, but instead it's just really moving mostly sideways here. And that 20-day EMA is starting to squeeze in on price. So that could be enough downside pressure to finally see this breakdown in Bitcoin that Carl and I continue to expect coming forth with crypto. Just not looking good for the cryptos at this point. And you can see PMO does have a crossover buy signal in the works on Bitcoin, but again, really not making a whole lot of headway here, despite a rising stochastics. And of course, we still have that negative RSI, so we don't want to see that. So the dollar, So the dollar, we've been looking at a cup with handle. We had here what looked like the breakout that was going to execute that pattern, confirm it, but instead price started to trickle lower. We were still considering the possibility of a bullish cup and handle, but this handle has now kind of gotten out of hand, if you will. And what we're seeing is a rising wedge on the dollar. And if I take you to a 1-year chart, it's going to be even more obvious for you. So the expectation from one of these patterns is a breakdown. Now we do have the 50-day EMA, and we do have this low right here in the gap support in here as well to hold it up. But at that point, we will have executed that pattern, we'll have confirmed that rising wedge. So we are actually expecting the dollar to continue lower. And when you look at our PMO, it is on a new sell signal, and you can see stochastics are starting to move lower as well. RSI still remains positive, but we are looking for a breakdown here in the dollar. What does this mean for gold? Well, it should mean good things for gold. Gold hasn't really been able to do much. It's been in a trading range now for quite some time. And we are expecting the breakout. We expect gold to break out, but it has been gold being gold, as my dad will often say, and it's just not going to do it right now. But overall, with the dollar looking weak, we do believe that in the short term, we're going to start seeing some movement out of the dollar. But unfortunately, our indicators aren't really confirming our belief right now. And so we have to take that into consideration, of course. RSI negative, PMO on the downturn could give us a sell signal beneath the zero line, which would be very bad news. And of course, we could see that stochastics turned down in negative territory for GLD. So, you know, the dollar's not looking healthy, but gold isn't really taking advantage yet. We'll see if the dollar does break down. At that point, I would start looking for that breakout in gold. But right now, it's just meandering sideways, gold being gold. Now, the gold miners have been really struggling, obviously, with gold struggling. The miners are affected by that, but they are also affected by the market wins as well. And they haven't been faring too well against those wins. We are at very important support right now for gold miners, but we still just don't have a heartbeat as far as the membership of the gold miners. We still don't have any. Now, this is from Friday, so this could change today, but we don't have any stocks of gold miners above their 20, above their 50, or above their 200. I don't know about you, but that's not where I want to go looking for investments in a industry group that is suffering to this degree. Our chances of picking out those winners that will lead the rally out are going to be, you know, very, very difficult at this point. And I just don't see enough here to tell me that this is going to be the big bounce area. The only thing that's telling me that right now is that support is so strong here. But at this point, PMO is in decline, RSI negative. There's nothing here to tell me we're going to break this declining trend. Gold miners, I think we will manage to hold this support level, but I don't think it's going to go very far, at least not yet. Like I said, if the dollar starts to go south like we think it will, that will change the whole landscape for gold and gold miners. All right, USO. It actually has rallied Friday and today off of very important support. It's holding up this intermediate term rising trend line. We're feeling a little bit better about energy and oil, but we don't have enough confirmation here to be, really jumping in head first into the energy sector. And like I said, we're going to deep dive in there after I cover the rest of this. Actually, I have only the bonds left and some interest rate charts. But after that, we will look a little more closely at the energy sector. This is good for the energy sector to see this reversal here, but I wouldn't really trust this until we get above the 20-day EMA. There's just too much overhead resistance. I would be looking for more sideways movement. Of course, stochastics are starting to hint, as is the RSI, that we might get that breakout we're waiting for here, but we need to be careful. This could be a reverse flag setting up here, which would mean a continuation to the downside. we look at the 1-year version, again, you can see the importance of price holding this rising trend, which it is doing. So there is certainly some hope out there for oil. I just am not totally on board that we're done with that correction. So we have to be really careful. Well, with interest rates doing what they've been doing, it's put a lot of pressure on bond funds of all duration. And of course, the 20-year is no exception. Looked good for bonds. It looked like we might be able to enjoy a little bit of a rally, just like we did back here. We were thinking that it might be, a longer lasting rally, but no, interest rates have reversed and they are rising again. And that has caused TLT to break down yet again, even after that break above the 20-day EMA. Now you do have some support sitting here. We're going to look at a weekly version, but this support level is still rather weak. The strongest level is going to be down here at about 104.50, maybe 107, but that's the support zone. And we really haven't tested that support zone, which means I think we are vulnerable to continuing to see rising rates and lower prices for bonds. Let's take a quick peek at the 10-year Treasury. As you can see, we're looking pretty good right now with this rebound, also like with oil, rebound off of the rising trend. This is a rising wedge, though. This is a bearish pattern. We were expecting the breakdown this last time, did not get it. And now instead, we're going to head back up, possibly for another run at this area of overhead resistance, possibly even moving to the top of the rising wedge formation. PMO is on a sell, but stochastics are putting on the brakes. Maybe we're going to see that reversal. PMO is not on board with that rebound up to the top of the rising wedge, but RSI and, like I said, stochastics are hinting that that could very well happen. All right, let's keep it going here. Let's move on into the energy sector and see what is going on there. And as you can see, it's been, whoops, that's comm services. Here is energy. So energy today just had a dark cross of the 20 and 50-day EMAs. That is an intermediate term trend model neutral signal for energy. It is neutral because this crossover occurred above the 200-day EMA. So nice little rebound here off of strong support for XLE, similar to the look we're getting with oil, which would make sense. But again, we have to be very, very careful here. Notice the participation has just fallen off a cliff. And currently we don't have any, and again, these are numbers from Friday, it might change. I imagine it's going to change today, but we did not have any stocks in the energy sector above their 20 or 50-day EMAs. That's pretty beat down. That is a pretty severe correction. So certainly this could be enough to spur energy for a rebound. This is obviously very oversold conditions here. And we would look for them to improve today, given that energy did have its best day amongst the sectors. It was up almost 3% here. So really nice rebound coming off of important support. We just don't trust it just yet based on the participation. And again, based on that dark cross that we're seeing on energy. So that's your under the hood view. Notice our silver cross index. So this measures how many stocks in energy have a 20-day EMA above the 50-day EMA. And that really also fell off a cliff. When we start to see that turn back around, I'll feel a little bit better about the energy sector. But right now, I think we still have to tread very lightly there. I'm watching carefully because I had energy positions I got rid of, and I am ready to jump right back in. So we're keeping a close eye on this, and we will certainly let DecisionPoint subscribers know when it might be safe to get back into the energy sector. Healthcare, looking pretty awesome right now. This was my sector to watch last week, and it's just really taking off. Diamond subscribers, I talked to them about biotechs starting last Tuesday. So a lot of them got in on the nice breakout for biotechs. We'll look at that a little more closely. I'm kind of giving you a hint, aren't I, at those diamonds in the rough. So we have a nice V bottom here. Really on Thursday, honestly, I'd say even on Tuesday when I did present to subscribers, right in there when we passed above that 20-day EMA, we closed this gap back here. That was really our sign with a V bottom. You want to retrace about 1/3 of that pattern. And once you do, the expectation is a breakout from the left side of that V. So there is more movement left, I think, for healthcare. And when you look at the participation numbers, it's really looking much better than energy, right? We have the silver cross that is rising, almost giving us that positive crossover. And notice the improvement in participation for healthcare stocks. We have what we call a bull stack, meaning there's more above their 20 than above their 50 than above their 200. That tells you momentum is moving into the sector as price gets above the 20, and now they're starting to get above their 50. Stochastics, look at the relative strength currently, PMO buy signal. It's really hard not to like the healthcare sector when you look at this chart. So we've taken those deep dives. Let's go ahead and look at those industry groups that I am stalking, if you will. So I pointed out to, I believe it was to subscribers last Friday. Yes, diamond subscribers, I did mention that the water group was starting to look really interesting. And in all honesty, I feel bad I didn't bring it to them even earlier, because once we had this V bottom here on water, it had corrected so quickly. This is in that staple defensive type area. I would have expected to not see this big decline, but when the market started to do a little better, maybe that makes sense. But we're starting to get a really nice rebound here on the water index, and I'm liking that area. So you might want to go diving into that industry group to find a stock or two. I know that American Water Works, AWK, is kind of the leadership one in that group, and full disclosure, I do own that. So other industry groups of interest. In technology, I would say that renewable energy has started to look very good. Talk to my subscribers about that as well. In diamonds, nice double bottom that is shaping up here. You can see today we're getting above that 50-day EMA on the close, really set up nicely. And I'll tell you what, these stocks have been beaten down so far. There's certainly a lot of potential in this group, but I would warn that this group can be very, very volatile, kind of like the biotech group. That's why it was kind of hard going in with my subscribers on biotechs and renewable energy, because both are very volatile. They can turn on a dime. So if you're gonna deep dive into that group, if you're gonna start looking to fish from that fishing hole, just be very careful. Consider stops, hard stops, not in your head, mental stops, because these groups can really turn on a dime. Other groups of interest. I know I like real estate, but I'm not going to highlight any of those. I wasn't fond of chemicals. Aerospace in the industrials has really started to look interesting. Notice the breakout above the 20-day EMA for this index, and the PMO has whipsawed back into a buy signal, and notice stochastics rising as well. So I think aerospace is looking very interesting right now. And medical equipment has some potential. It's pretty beat down, so again, I'd be a little careful here, but a nice close above the 20-day EMA for the second day, and notice PMO buy signal now in effect. And you can see stochastics rising and now in positive territory. So I think that the medical equipment looks interesting. I talked biotechs. Here's the biotech chart. I was getting very interested in it when we were seeing that PMO turnover for the buy signal, stochastics improving. And again, you can see that price is now above that 50-day EMA, big time double bottom here that will be confirmed if we get a breakout above this confirmation line right there. Healthcare providers also looking very interesting with their breakout here. Healthcare is really, there's not a lot of bad areas in this sector. This is medical supplies, again, very beat down, so be very careful, but the indicators have certainly shaped up. Pharma making a big breakout to, it looks like, new 52-week highs for that particular index. Certainly plenty of large cap stocks to look at in that pharma area. And finally, here's energy. This is why I'm not completely on board. Yes, we're seeing some bottoms here, but we've got price well above these 20 and 50s, and notice these dark crosses that are also appearing. So that's why I think that we have a better shot at making some money. Not here in energy just yet, certainly making the turn, but I just don't think it's ripe enough. I'm a momentum trader. I need to see more from it. Other one of interest is soft drinks. We have a declining trend here that's now been broken. Price for the second day closed above its 50-day EMA. There's still some room here before it hits some overhead resistance, but I'm thinking this looks good. Might want to take a peek at Coke or Pepsi. All right, but here are my diamonds in the rough for the day. So let me get there for you. So Biogen, I was talking biotech. So here are some choices in the biotech space. I always put a stop level in when I present these to Diamond subscribers. The top part here is when I presented it to them. So you could certainly raise your stop if you're getting in now, and not, as soon as my subscribers were able to, but you can see that things are still looking great on this chart. When I picked it, stochastics were way down here and they're now oscillating above 80. PMO is now above the 0 line. I think this one is just looking better with age. And here is XBI. This is the biotech ETF. Full disclosure, I do own it. Nice little double bottom here. And you can see flat price bottoms, but rising bottoms on the OBV. That suggests that we will have a rally that will sustain. And sure enough, it did. It broke out. Next up, though, we do have overhead resistance here at about $80. Looks like about 80. So that's still about 4.25% before we have to really worry about overhead resistance. So I still think this one looks pretty good. And finally, before I go, here is ABV. This one, ABV, is looking pretty good as well. Nice breakout. It's at overhead resistance, and I do notice a black candlestick, filled black candlestick. Might be in for a little bit of some consolidation after this breakout, but ultimately PMO on the buy signal. Again, RSI positive. Look at the relative strength, looking great. That's all I have for you today on the Decision Point Show. Hope you enjoyed it, and we will see you not next Monday, but the Monday after.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.